Good afternoon and welcome to ICG Enterprise Trust's full year results for the 12 months ending 31st of January 2023. I am delighted to be joined today by Oliver Gardy and Colin Walsh, who are going to talk through our performance over the period. The slides for the presentation, along with the accompanying announcement, are available on our website. As a reminder, we will have time for Q&A at the end of the presentation. If you would like to submit a question, please do so through the online portal at any point. With that, I'll pass over to Oliver.
Thanks, Chris. And thank you all for your time today to join us on this webinar. We are very excited to announce that the ICG Enterprise Trust has continued to deliver defensive growth against a challenging market backdrop, with our portfolio delivering its 14th consecutive year of double-digit growth. And we generated an NAV per share total return of 14.5%. As you know, private equity is a long-term investment, and over the last 5 years, we've delivered an NAV per share total return of 16.9%, significantly in excess of the FTSE All Share. What have we done with the portfolio as of this year? We continue to invest for future growth by taking advantage of a buyer's market. We're actually excited about the opportunities over the entire spectrum and therefore making new commitments in top-tier funds as well as investing in secondaries and co-investments. The realization activity in fiscal year 23 was also robust despite challenging markets. And importantly, our managers continue to realize investments at meaningful uplift carrying value. We believe this reflects the demand for quality assets, particularly in a more uncertain macroeconomic environment. Our fiscal year 23 realizations also included some of our larger exposures within the top 30. This has continued into the new financial year, including the exit of Endeavour Schools, which was our our third largest investment in the top 30. Finally, touching on shareholder returns, which has been a key focus for our board this year, we remain committed to our progressive dividend policy. We announced a buyback program, and we improved the managing agreement, which shall be positive for future shareholder returns, and we'll talk about that later in the presentation. So let's look at the year by the numbers. Our portfolio grew to £1.4 billion, whilst NAV per share increased to 19.03p, delivering double-digit returns on both a portfolio and on the NAV level. Shareholder returns were supported by a dividend of 30p per share, an increase of 11% year on year. And since October, our share buyback program delivered over 2 million in capital returns in fiscal year 23. As you know, we have continued with our buyback program in Q1 this year. Our investment and our realization activity has been particularly well balanced. We made £287 million in new investments, and we made the total commitments of £274 million. And I will discuss more detail on our investment activity on our next slide. Despite the wider market commentary, our realization activity, both in terms of volume and value, remained robust throughout fiscal year 23. And we're particularly proud that we have been able to complete 54 full exits in the year, generating just over £130 million in proceeds at an average uplift of 24%. This uplift should give shareholders additional confidence in the conservatism of our portfolio valuations. But let's move on to the next slide. And I'd like to show here a snapshot of our portfolio activity and performance by investment type. As you see here, we saw resilient returns across all segments of our portfolio. Our new investments during the period were well balanced between primaries, directs, and secondaries, and in line with our target portfolio weightings. We are particularly excited about the opportunities in the secondary market, and we are focused on increasing our exposure in the secondary market. And as a consequence, we made 2 commitments to ICG management funds on secondary investments, which are off to a great start. Our differentiated access to the ICG platform is a valuable asset to the ICG Enterprise Trust. As you see here, we've generated strong fund performance and attractive co-investment opportunities, such as Doc Generici, back in 2019, which was our largest realization during fiscal year 23. And we made in fiscal year 23 4 new co-investments, including ChronosNet and ECA Group. Let's look at how each component contributed to the portfolio performance. Our primary investments delivered an 8% local currency return, and our primary investments are naturally diversified, and it was encouraging to see that performance was broad-based and supported by robust earnings growth. As a reminder, our primary investments is the core source of deal flow for our direct investments, which typically deliver outsized returns. And this was indeed the case this year, with direct investments generating 15.5% return. The notable drivers here were Endeavour Schools, European Camping Group, and IRI. Meanwhile, our secondary investments generated 11.5% local currency return. Notable drivers here were, and the return was mainly supported by the strong performance within the ICG managed secondary investments. Overall, I believe that our performance during the fiscal year is a testament to the quality of the assets with our portfolio. In a year of increasing macroeconomic volatility, we've been able to generate double-digit returns on both a portfolio and on an NAV level, supported by resilient operational performance, which Colm will discuss in a second. With that, I'll hand over to Colm and discuss the portfolio activity of the year.
Thanks, Oliver. So starting very importantly with realizations. So in the year to the 31st of January 2023, the portfolio generated realization proceeds of 252 million. That equates to around 22% of opening portfolio value. So whilst that's a little lower than an especially buoyant 2021, it's in line with our 5-year average. During the year, as Oliver's already noted, we completed 54 full exits at an average uplift to carrying value of 24%. And that continues a long track record of material uplifts to carrying value on realization. The ability to deliver significant uplifts demonstrates the quality of our portfolio. It also demonstrates that the kind of investments we have, highly in-demand investments, find interested buyers even in difficult markets. And it also supports our confidence in our portfolio valuations. As Oliver's already noted, we didn't observe any slowdown in exit activity in the second half of the year. And you can see from this chart that the pace was well balanced from quarter to quarter. And the activity has continued into the new year with the successful exit of Endeavour Schools, and that completed in February, just after this January year end. And as Oliver has already noted, that was the third largest portfolio position at the 31st of January. Exit activity included realizations of a number of our larger holdings, and I'm going to take you through one of them in a second, Doc Generici. Moving on to the next slide. So Doc Generici, known as Doc to its friends, was an ICG managed investment alongside our ICG Europe colleagues. And that was through both a primary and a co-investment. And in the third quarter of 2022, Doc Generici was the 7th largest holding in our portfolio. It's an Italian company headquartered in Milan. ICG has a long and successful track record of investing in Italy, where we have an experienced team and local on-the-ground presence. Doc is a leading supplier and distributor of pharmaceuticals, and it's been a pioneer in the shift towards generic drugs, particularly in the Italian market. Obviously, the European pharmaceutical market is highly regulated, and that creates significant barriers to entry, which has allowed Doc to establish a strong market position in a highly concentrated market with attractive characteristics. The company exemplifies a number of our core defensive growth criteria, which I'll go on to discuss in a later slide. It has a strong market position. It operates in an industry with very compelling structural growth drivers. It's highly cash generative, and it has a best-in-class management team. The investment was realized in the fourth quarter. It generated proceeds of just over £24 million, representing our largest realization. It had a relatively short hold period of around 3 years, resulting in an especially strong IRR performance. And I think Oliver's already touched on this, but the success of the deal is a reminder of the significant benefit to our investment program through being a part of the ICG platform, as well as being a great exemplar of our defensive growth approach. So having discussed the realization side of portfolio activity, I'd now like to spend a little bit of time on some of our new investments. So in the year to 31st January 2023, we made new investments of 287 million. So that's equivalent to approximately 25% of opening portfolio value, and again is broadly in line with our 5-year average. And it's similar to the level of distributions which we've just discussed. As all of in the mid-market segment where our portfolio is focused, the levels of activity have been less indexed to the broader market, which has been quite skewed by larger deals, and therefore deals have continued to happen, albeit with an increasing focus on the highest quality investments. We invested relatively evenly over the year, with a balance of new investments between primary, direct, and secondary investments, broadly reflecting our revised target allocations. Within our direct investments this year, we continued our focus on identifying resilient investment opportunities. A particular theme has been finding deals with structural downside protection, such as Precisely, ECHA, Newton. And we believe these deals will have attractive risk-adjusted return potential. Turning now to new commitments, critical to lay the foundations for a successful future investment program. 2022 was an exceptionally active year for fundraising more broadly in the market, and the market dynamics, where there were a large number of high-quality managers competing for a limited pool of capital, benefited our primary investment program. Our new commitments this year gave us access to an extremely attractive selection of top-tier managers. We've introduced 3 new managers, indicated by the star on the chart here, to our portfolio during the year. And all of these managers we've been tracking for some time. And we've also continued to back a number of our long-standing relationships. For example, PAI, with whom we've been investing for the last 18 years. And PAI continues to be one of our strongest primary and co-investment partners. These are all top-tier managers. They typically have long track records of delivering resilient returns across multiple economic cycles. And most of these offer a differentiated pipeline of attractive co-investment opportunities. These commitments, which we expect to be drawn down over the next 3 to 5 years, plant the seeds for the future of our investment program. And we're optimistic that the next few years will be an especially interesting and attractive time to invest. So now I'd like to move on to look at our current portfolio composition. And this slide provides a dashboard, if you like, of our portfolio construction. And you can see that our top 30 companies represent a little under 40% of the total portfolio value, with our top 50 being just under 50%. The way we think about this is that the performance of our largest exposures impacts our overall NAV performance, but without taking excessive single company risk. Our portfolio is constructed to provide exposure to the buyout market with a balanced exposure to the 2 major geographical markets, Europe and North America, a balanced exposure to different sectors, and also, as I just noted, a balanced exposure to the type of investment, in other words, primaries, secondaries, and directs. We've provided guidance on our revised target portfolio composition, and those target weightings are shown in the grey dotted boxes on the chart. This year, we have seen some material realization activity from within our top 30, and that has reduced slightly our allocation to co-investment. And conversely, our exposure to secondary investments has grown during the period, which is part of our long-term plan. We're continuing to build out that segment of our portfolio. I'd now like to briefly cover some of the qualitative characteristics of our portfolio companies, and in particular, some of the characteristics of our defensive growth approach. In practice, many of these companies, and you can see the logos here on this chart of many of our larger exposures, meet multiple criteria. So if you take, for example, Visma, which provides accounting, payroll, business enterprise software effectively, it has a very strong competitive position. It provides mission-critical services to its customers. It has high margins, and it also has very strong pricing power. Similarly, IRI, one of the other logos you can see here, is our second largest holding at the half year, remains in our top 30, albeit at a lower ranking. And the reason for that is that it was partially realized during the year. We received proceeds of just under £23 million, and it's been merged with a competitor, NPD. We're very excited about the future prospects of this company. And again, just like Visma, it exhibits all of these characteristics. It's a market leader, it has a very defensive business model, and we believe that that market has very attractive future growth potential. And just touching briefly on new entrants, 3 new companies in the top 30 during the year, ECHA Group, Newton, and Vistage. All co-investments, as well as being held to our primary funds program. 2 of these investments, ECHA and Newton, are alongside ICG, and Vistage is alongside one of our long-standing US managers, Gridiron Capital. So moving now on to look at how the financial performance of our portfolio compares to public markets. And this chart, which you can see here, compares average EBITDA growth of our top 30 exposures with the FTSE All-Share Index. Now, as Oliver's already noted, our top 30 companies have generated very strong financial performance, with weighted average EBITDA growth of 22%, compared in this period to the FTSE All-Share at 8%. But I think the most important takeaway from this chart is not so much just the numbers, it's the consistency of earnings growth that you can see within our portfolio. And you can see that the public markets over this period have exhibited much higher levels of volatility. And for me, this underscores the resilience of the businesses in which we're invested. We've also spent time trying to broaden our disclosures around portfolio performance to include a larger proportion of portfolio companies. And this is summarized on the next slide. So this slide provides an overview of the key financial metrics for the underlying portfolio. And it expands on the enhanced disclosures that we provided for our half-year results. You can see on the top row the performance of the top 30, which I've given already, which was shown on the previous slide, while the bottom row provides the same data for what we call the enlarged perimeter, and that represents roughly 3/4 of total portfolio value. And as you can see, they're broadly consistent, and we believe that reflects the broad-based growth across the portfolio. Touching on some of these metrics, the top 30 weighted average EV/EBITDA multiple decreased from 14.6 times to 14.3, and leverage increased from 4.3 times to 4.7 over the year. Both changes are substantially due to the mix effect. In other words, changes in composition and weightings of individual companies. And in the case of the net debt multiple, it also reflects realization activity, whereby larger, mature investments, which have reduced debt over their hold period, are replaced with newer deals that typically have higher leverage levels. And we've also included some more detailed dashboards showing the dispersion of performance within these data sets. And these can be found in the appendix to this presentation. It's part of a broader initiative to provide investors with enhanced disclosure and transparency around underlying company performance. And it's an initiative which we'll be looking to extend. So with that, I'm going to pass back to Oliver, who will discuss how this performance translates into shareholder returns and who will conclude the presentation.
Thank you, Colin. So as a reminder, in our fiscal year 23, our portfolio generated a local currency return of 10.5% and an NAV per share total return of 14.5%. We hold ourselves to account to deliver long-term returns for our shareholders. And if you look at on the 5-year analyzed basis, we have delivered a portfolio return of 19.1% and an NAV per share total return of 16.9%. I believe you'll see here the resilience of our portfolio well illustrated by the consistency of the returns. The column showed you in terms of consistency of the earnings, but here you see also in terms of the NAV growth shown in the chart here on the right-hand side. We delivered positive quarterly returns for 17 out of the last 20 quarters. However, annoyingly, nobody is perfect, and I'm very annoyed that we just missed the last quarter of a positive return with Q4 23 down by 0.3% quarter on quarter in NAV per share. However, that is due to the FX impact of sterling strengthening, and which more than offset a local currency portfolio return of 2.3% for the quarter. So I hope you forgive us that last quarter is just down from about 0.3%. However, despite this consistent growth in portfolio and NAV, we're of course aware that our shareholders have experienced a bumpier ride. And let's discuss what the board and what we as a manager are trying to do to optimize shareholder returns. So we have had an increased focus on the level and the form of shareholder returns. While capital appreciation is expected to be the core driver of growth, we have a number of additional mechanisms in place, and we put in place in the last 12 months to enhance returns for our shareholders. So firstly, dividends. Our fiscal year 23 dividend of 30p per share represents an 11% annual increase, and we maintain our commitment to a progressive dividend policy. Secondly, we should talk about buybacks. In October, we introduced a new long-term buyback program. Since then, we've returned over £5 million to shareholders via buybacks at an average discount to NAV of just over 40%. And lastly, we agreed on an improved management fee agreement, capping fees of at 1.25% of NAV, as well as enhanced cost absorption by the manager, both of which came into effect as of the 1st of February 2023. So we believe and hope these measures demonstrate our holistic approach to optimizing returns for our shareholders, and we are confident that that should help us, particularly in regards to volatility in the share price. Now, what I like to wrap up here is giving you a bit of view on historic as well as looking forward. And as you've seen in this presentation, I hope you've seen that you share our belief that our performance over the last financial year really does show defensive growth in action. Our portfolio companies delivered compelling operational performances, and we continue to realize assets at a meaningful uplift carrying value. We've capitalized this year on attractive investment environment and vintage, and which we should lay the foundations for our investment program over the coming 3 to 4 years. Looking ahead, whilst we can't independently shape macroeconomic trajectory, what I have, however, learned over the years that in more challenging environments, it is all the more valuable to be invested alongside leading managers with proven track records. And if you look at our funds, it gives us a lot of confidence that they can continue to deliver outstanding operational transformations and compelling returns across economic cycles. Furthermore, we believe strongly that we are currently experiencing an attractive investment environment as liquidity becomes more constrained and valuations are adjusting. The secondary market is a particularly interesting buyer's market, since many private equity investors are forced to prune their portfolios in order to create some liquidity for making new investments and continue to invest in private equity. And lastly, our proven investment strategy has guided us as well through the volatility of the past 3 years, and we continue to focus on constructing a well-balanced portfolio of top-tier buyout managers and defensive growth companies. With that, I would like to conclude the presentation, and I thank you very much for your time today.